Well, hello, Kevin and Tony. Good morning and welcome to our webcast. Excited to have both of you here this morning. Today,
Excited to be here. Thank you,
yeah,
Mary.
I think this
Hey,
is going to
Marty.
be a great discussion. It's an issue that I think is very much misunderstood and um, important for both buyers and sellers in staffing industry and human capital management, mergers and acquisition. I've kind of given that titled this webcast, Unpacking the Complex and Often Misunderstood World of Tail Insurance. And let me paint a little backdrop from my experience as to why I think this is an important topic in human capital management M&A. By way of background, which you folks know well, I run the human capital management industry M&A practice here at Becker. I have the privilege of spending 100% of my time on human capital management M&A and not in other industries. So, with the volume of deals that we do, and I do think it is the largest in the country. We average about 11 closed transactions a year in this area, working with buyers, sellers, PE firms, large strategics, folks who are new to M&A. I get to see a lot of different transactions, a lot of different issues that arise. And in my experience, many acquirers in our industry underestimate the tail exposure that could be out there and then have not thought through the role that tail insurance can play in protecting them and protecting the seller from that tail exposure. And then you kind of couple that with the fact that, you know, the sellers are probably even less informed than the buyers, right? We've got some very sophisticated buyers, and the spectrum of buyers, goes from sophisticated to incredibly sophisticated. But sellers aren't in the business of mergers and acquisitions, right? So of course,
Right.
a lot less informed. And we're talking about insurance. It's a professional topic. It's a complex topic to start with. So you've got sellers who are less informed. Sellers also have a big belief in what they've done. They've built something great, and that's the way they think of it. So of course they don't think they have tail exposure. They believe they're operating their company without exposure. So you combine buyers who maybe don't pay enough attention to this topic with sellers who come in with their own biases, and of course, resistance to the cost, because quite often the cost of tail insurance is put on sellers. And I'd say the overwhelming majority of time that the cost of tail insurance is rightfully put on sellers. So you get a situation here where I think we don't always end up with the right solution in place. And not having the right solution hurts both parties actually in the transaction. So since you are the two guys that I call when I'm in the middle of a transaction and have questions in this area, I thought, all right, why not get these guys on our webcast and just talk about the issue. But before we really dive in any further, for folks who don't know you two, why don't you introduce yourself? And Kevin, you want to start first?
Sure. I can start. My name is Kevin Turner. I'm a vice president over here at Acrisure for our staffing practice group. I've been working with my colleague over here for 20 years, specifically, not 100%, 99.9% of my time in the temporary labor industry and human capital management industry. Acrisure as a whole, we're about I would say with the fastest growing in the country in the history of insurance, as far as fastest growing insurance brokers, probably about $4.5 billion in revenue right now. Our specific practice group has over 150 or 160 staffing firms today. And they do get us involved very, very early on in the M&A process. For the most part. And they talk to us and maybe to say, hey, who do you know as an industry practice group? And a lot of times we bring you in. So that's my experience in staffing. I'll let Tony go a little further.
Yeah, and like Kevin, I am a vice president here at Acrisure as well. My name is Tony DiMcAntonio. Been with the group for almost 20 years now, side by side with Kevin, and spend all of our time in this staffing industry and human capital management. And Marty, like you were saying, really, the devil is in the detail in these transactions, right? So you want to make sure whether you're buyer or seller that you're utilizing professional help to understand the contracts as well as any industry specific nuances that pop up. And that's exactly what Kevin and I do for our clients, whether again, buyer or seller.
Yeah, thanks, guys, for the introduction. All right, well, let's dive in. I mean, I think that we should start with maybe some of the basic concepts that underlie what tail exposure is and what tail insurance is, because if you don't understand these basic concepts, it's hard to then move to the next level and make the right decisions about, how you're going to um, deal with tail exposure in your transaction. And insurance is one component of it. And then the deal documents is the other component of it, right? And you have to really understand both, right, to come up with the right combination, because there's a combination usually of things you can put into place to create the right scenario for both the buyer and seller. So in terms of key concepts, maybe we just start from the simplest, Tony. What is tail exposure and what is tail insurance?
Yeah, sure. So tail exposure is really very straightforward in the sense that every company, every FEIN number essentially has trailing liability associated with it, right? And whether that entity is sold, whether that entity is closed, there is business risk that will continue to be attached to that entity. And that's truly the tail exposure that we're talking about here today. There are a lot of insurance solutions available, which is where the word tail insurance comes into play. But insurance is not a solution for every form of tail exposure. So, for example, tail insurance, most people are used to seeing with all the coverages that are common in our industry, like employment practices liability, directors and officers, professional liability, third party cyber, things like that. There are insurance solutions for in the form of tail insurance. But there's also trailing liability that a lot of our clients, especially in the light industrial staffing vertical, have in the form of workers' compensation, right? There is no true tail insurance available for workers' compensation. There's some other solutions that are in play that are utilized, but it is not in the form of insurance. And all forms of that tail exposure need to be contemplated and addressed so that the buyer is not inheriting that business risk that was associated with that entity.
Thanks, Tony. And Kevin, I think there's another concept. In insurance, we have different types of policies, and different types of policies act differently when you get into a transaction and you're selling a company, right? You're selling your company or you're buying somebody else's company. Most common that I always hear of are claims made and occurrence. Can you explain, you know, these different types of insurance and how they impact a buyer's thought about tail insurance?
Yeah, Marty. Interestingly enough, if someone's not in the insurance business and you try and explain occurrence and claims made, they literally they go blind. They're like, I have no idea what you're talking about. So let's just talk about occurrence policies first and why claims made exists. An occurrence policy is simple. A business buys an insurance policy in 1980, and if something occurs in 1980 but the claim doesn't come until the year 2000, and the insurance carrier had no idea that risk even existed, they're still on the hook for that issue. So, I mean, give you an example, asbestos, okay? Insurance carriers were insuring for years, didn't know asbestos was an issue, and the next thing you know, 30, 40, 50 years later, they're still getting pulled into asbestos claims. So they came up with this wonderful policy called the claims made policy. What does that mean? That means they write the policy, let's just say 2024, there's a claims made policy in place, and that policy in its existence. And for coverage to exist and continue, you have to buy a policy the next year. So, for example, in in the staffing world, if you buy an insurance policy that protects you for your professional exposure, all right, in the year 2024, and then the next year you don't buy that policy, that coverage stops. It doesn't continue. So if the occurrence of a professional liability claim occurs in 2024 and you stop buying the insurance, if a claim occurs, it doesn't matter. You don't have coverage anymore. So when a claims made policy, the coverage stops responding. Does that make a lot of sense, Marty? Like that's the issue here.
Right.
Until you continue to keep buying coverage, coverage ceases to exist. An occurrence, if the incident of a loss occurred, the insurance carrier is on that infinitum. And they have to respond to it. The policy has to respond. So that's kind of the key difference there.
Yeah, that's a perfect explanation, because what you're worried about in transactions is kind of this imaginary line, which is the pre-closing operation of the company, and then the buyer takes over, and then there's the post-closing operation of the company, right? And the buyer doesn't want to have any exposure to this half of the line, right? So what you're basically saying, as I understand it, if it's occurrence policies in place, okay, the buyer has coverage if it's discovered after the line, but if it's claims made, those policies may end. And what do we do? And that's where the tail insurance comes in, right?
Exactly. And Marty, I think it's a perfect segue to kind of another piece of it, which is if you're a buyer and you're buying a seller, obviously, and the seller has an occurrence-based policy, just because the occurrence-based policy is in place, it doesn't mean coverage is good. So you could be buying an occurrence-based policy where the coverage that you want isn't there. So it's not that coverage stopped, it never existed. So one of those things, or just because it's occurrence doesn't mean it's good.
Right.
So one of those little things and nuances that we always talk about.
Right. And well, but the same thing, as I understand it, from tail insurance. So even if you have a claims made policy, you buy tail insurance. Tail insurance, again, you guys are the experts who I call, but 9 out of 10 times is just an extension of the insurance, the claims made policy before. So this is something I try and tell buyers all the time. If it's not covered in the policy to begin with, it's not covered in the tail policy, right?
Yeah.
So can you give some examples, or an example, because I know we're always short for time in these, one of you, of the things that you'll see, maybe EPLI policy that is missing, right? In the policy, we get tail coverage and it's still missing.
Yeah, and I can jump in here, Marty. You're exactly right. So EPLI is a perfect example of why in our world due diligence is so important, right? And I know it's a pain. Nobody wants to continue to pester the seller for a list of policies that they need and things like that. But you can't just check off the list when somebody shows you like a certificate of insurance and say, oh, okay, they purchase EPLI, I'm good. Well, you've got to dig in under the hood a little bit more, because in our world, right, of third-party capital management here, you've got employees that are temporary in the field, and you've got employees that are internal to the company. Most standard insurance carriers who are not staffing experts are only going to provide employment practices liability for internal employees. So we've seen numerous policies where people are saying, yeah, we've got EPLI, we're covered, or you're covered going forward. The reality is that's not going to do you any good if you've only got the internal employees covered and the whole workforce that's out in the field is uncovered. So that's a perfect example of where you're really not buying anything.
Yeah, and I see, look, the mergers and acquisitions, it's a complex topic altogether, right? You can slice up, we've got a very complex and misunderstood segment of it, but we can slice this up and find 100 segments of it. What happens to some folks I see is so much focus on financial, which it should be. They don't get to these issues to the end, right? And it's often hard to come up with solutions when you're figuring this out a week before you're going to close, right? So one best practice I think that you guys just hit on is get somebody to look at your policies right away at the beginning, understand what you have in place, because that fits into your decisions about tail coverage, that fits into your indemnity escrow decisions, that fits into your rep and warranty decisions, it fits into, you know, a whole bunch of cascading elements in your agreement. And if you don't get that information out early, it's unlikely you're going to match things up correctly at the end of the day. Um,
Absolutely.
and Kevin, back to you, and I think we've hit on it a little bit. Maybe you can bring it home. Look, transaction can take many forms. We're only going to the two most common are an equity purchase where the buyer purchases the equity, whether it be the stock or the membership interest in an LLC, or an asset purchase, right? We won't get into mergers and things that can be a little bit more complex, but those are the two most common way that M&A transactions are structured. Does that make a difference with respect to tail exposure or tail insurance when you've got, say, an equity purchase versus an asset purchase?
Yes, it does. And let me just segue back to something you said earlier, Marty, just because I think it'll hit critically to what we do and what you do is, yeah, you want someone to look at your policies, you want someone to look at your agreements, but you want someone who knows your industry to look at your agreements. That's the critical element because you work in staffing and human capital, I work in staffing, and Tony works in staffing and human capital. When we look at those agreements, that's great. But on top of that, we also understand what's out there that doesn't exist. So I just wanted to kind of tap into that because sometimes if you can grab an attorney, you can grab an insurance broker who's very good at what they do, but they just don't understand what you do. So I just wanted to tap into that real quickly and then step into why I brought that up is, you know, when you structure and the considerations you put into a deal, whether it's an asset purchase or a kind of an equity or stock purchase is, the critical element is just identifying areas of risk where risk does exist and determine one, if insurance protection existed and will it stop once there is a change in ownership. That's the first thing you have to identify. That's critical. And then if insurance protection didn't exist for those risks, is there an insurance product available to protect against those risks if desired? And whether it's a stock purchase or an asset purchase, those are the things you have to figure out. But I think the more critical element, especially for a stock purchase for the buyer, is identifying whether there are known instances of potential loss. And this is why you need to start early in the process. If there are known instances of a potential loss that could arise in the future, and remember, I'm saying known, not unknown, known. They have to be made aware of those because insurance carriers, if there is an awareness by the buyer or the seller, the insurance carrier will not respond to those instances. Insurance carriers don't want to write insurance for a hurricane that they know is coming. So that's one of the critical elements on the seller, on the buyer side, to make sure that they're protected. And there are things called like a runoff policy, for example, to protect against maybe coverages that you think that you want there or are not there. And you can actually buy coverage for coverages that didn't exist. So there's always a product out there for the stock purchase. I think it's a much cleaner transaction and it's really protecting the buyer in that instance. On an asset purchase, you see a lot more of that in staffing, and the trailing liability protections are critical because you want the seller to purchase some kind of tail insurance, one, to protect my interest as a buyer. And it's not my intent to take on any trailing liabilities of the seller. However, in the absence of insurance, in the event of future liability, if there's no insurance in place and the seller isn't financially in a position to protect or answer the claims associated with potential future liability, the buyer could get pulled in, which you don't want. So those are the two things that you really want to consider, whether it's an asset purchase or a stock or kind of a stock interest purchase. Does that help?
No, very helpful, very helpful.
Thank you.
The tail exposure, um, understanding tail exposure under the two different forms of transactions is difficult, and people often don't understand it, or they have a misconception. A lot of folks think from a tail exposure perspective, if they have the transaction structured as an asset purchase, well, they've cut off all the tail exposure, right? There's been this fiction, and this is from mergers and acquisitions 50 years ago, right? Because that was largely true 50 years ago, right? I wasn't alive, but I remember my professors in law school, telling me, that was the way that it worked. Well, it doesn't exist anymore. So people have a big misconception of tail exposure under a stock purchase or an asset purchase, and understanding how the insurance works is the first part of understanding how to deal with that tail exposure. One thing that's interesting, I think, Kevin, and it segues from this, and I'll just keep with you on the topic, is that there is opportunities from time to time to continue the existing coverage of the seller, right? When we're talking about tail policies, we're talking about something different than continuing the coverage of the seller. Can you talk about where that opportunity exists, and maybe talking about it in the context of a stock purchase or an equity purchase and an asset purchase, and to the extent that there's other nuances that you think are important about the possibility of continuing coverage?
Okay, yeah, I actually have a specific example of this, and it was actually, Marty, it was very critical in the deal getting done. So there was an instance where I did not represent the buyer as their insurance broker. I represented the seller. So I was about to potentially lose a client to the buyer. Always very depressing on our end, but it does happen. So to make a long story short, the EPLI experience of my client wasn't very good historically. For whatever reason, they just had, with the state that they're in and the jurisdictions that they're in, where EPLI is a much more difficult risk to insure. And the buyer had an insurance policy with a very well-known, very well-established EPLI provider in the space. And that insurance carrier for the buyer previously insured the company being acquired, which was my client. Okay. And the insurance broker for the buyer had full intention of just adding that exposure, that those employees and that historical company exposure to their policy. Their insurance carrier said, no, we're not bringing that on. We had that business before. We don't want it. It's bad business. And this happened about 3 days before the deal was supposed to be finalized. So the buyer called us and called the owner of our company and said, can we talk to the agent? And what we ended up having to do was this. So it was actually on 2 policies, but the more critical one was EPLI. We had to call the existing carrier of the seller and ask that the change in ownership provision, which stops coverage once the transaction occurs, is not enforced. So what we ended up doing, and the reason it's not enforced is the buyer is not a named insured on the policy. So what we have to do is get the existing carrier to continue coverage and continue insuring the seller's name on the policy on top of adding a new named insured, i.e. the buyer, onto the policy. That makes sense? So that's where the continuation of that coverage is extremely tricky. And if the carrier didn't do that, the transaction was going to get pushed off because there was no solution in play at the time. So in that instance, it wasn't advantageous. It had to be done in order to get the deal finalized. which, going back to getting this stuff done early and looked into early to plan for these potential eventualities is much easier to do than doing it last minute. So just that's one of those continuation of coverage of the seller where it was extremely beneficial to do that because there was no other solution out there.
Right. And the presumption, you're right, by buyers, at least most strategic buyers, right? Strategic buyers already operating the same business, already have their insurance program in place, usually a little bit larger than the company they're acquiring, maybe quite a bit larger. So usually pulling this into their program is part of what makes the acquisition attractive, right? So you're talking about that's what's usually going to occur, but I've had some instances as well. Look, we work for a PE firm, right? You make your first acquisition as a PE firm, you're continuing coverage in all likelihood, right? So there are instances where I've had the same type of issue, and it's important to understand that there's a possibility to continue coverage. And that also plays in if you're continuing coverage, how are you doing it and how are you structuring the transaction? Let's move on to kind of tail coverage again. Let's move back towards tail coverage and move away from continuing coverage. Talk about just a tough question because it's not going to have much background, Tony, but talk about general rules of thumb that you have in place as to when a buyer should require a seller to provide tail coverage.
Yeah, I take a pretty simplified approach to that kind of opinion, which is always. I mean, if you're buying a entity, there's no reason why you should be taking business risk that's associated with that entity if this is like an asset only kind of deal, right? Where the seller is going to walk away and be done. In that instance, the buyer should always be requiring tail insurance to be in place because of the situation we talked about earlier, where you don't want anything coming to circle around and come back to you. If this is a stock purchase, some of that is addressed or could be addressed a little differently because then you are inherently absorbing those liabilities already into your program. And at that point, it becomes more important to technically be sound with some of the provisions that exist in these insurance contracts and are crucial to making sure that coverage is going to be in play going forward. So, for example, you've got things called retro dates, continuity dates, pending and prior dates. And the quick answer is they all have to line up. But what that means is a retro date for a buyer could technically be newer than when the seller's first policy was put in place, right? So maybe it's a new entity. It was established, in 2022, and they're buying a company that's been around since 2015. That buyer's EPLI policy we'll use, for example, is going to have a retroactive date of 2020. But based off of this transaction, they're going to need to go back in time with a retro date that is going to match the seller's exposure. So that's really crucial to make sure you're identifying ahead of time, because any kind of claim that occurs needs to occur after that retro date. So if there was something that happened squarely in between 2015 and 2020, right, like a 2017 occurrence, but the claim doesn't get filed until tomorrow after the deal is done, then that claim would be excluded if you didn't address that retroactive date. Continuity date, similar concept. It's just more about who is aware of certain claims or of any claims, and making sure, again, that continuity date goes back far enough to contemplate any kind of previously known claims, and pending and prior is closely related to that as well, where Kevin touched on this before, right? An insurance company is not going to want to insure a known hurricane that's coming. So like if we know that there's a claim that's actively being handled under the seller's policy, that will be excluded because it's already covered elsewhere. But in our industry, we've actually seen an interesting example of a carrier trying to cite pending and prior. So the situation is, let's say we've got a light industrial staffing company and they're staffing at ABC Logistics, and there was a big EPLI claim at at one location with one manager on site there. We've seen a carrier take a stance with pending and prior come deal time to say, you know what, we're also going to exclude any future EPLI claims that come out of this location with this manager in place, which is super aggressive and obviously something that is pretty much outside of staffing companies' control, right? So it's one of those nuances that when you're looking at deals and understanding significant claims that occurred, there is still impact going forward when it comes to tail coverage. And again, that's a super detailed example of a carrier that we've seen go, way aggressive. Usually it's not that bad, but it was a pretty bad claim, as you could imagine, for it to get attention to that level.
I mean, that's an incredible result because, as you said, the managers probably, I assume, was not the staffing firm's employee; it was the client's employee. And given that, the staffing firm probably had no ability to change that, swap that manager out, and therefore had no future coverage. That's incredible. But even before that, when you're talking about the retro and the continuity dates, I don't think, I mean, that's the complexity of this world. I don't know that many buyers, as sophisticated as they are, truly understand some of those concepts. And yet, you know, I'd say 40% of the transactions we're involved in probably have that exact circumstance that you said, where the retro date that they're bringing in because they're a relatively new company that's making the acquisitions compared to the firms that they're buying is big gap. And I don't know that they understand the significance of that. So it's a critical point there.
And it's interesting, Marty, on a somewhat related topic. We have a very unique ability in the staffing space to have professional liability covered on an occurrence basis, right? So the three main programs that exist, staffing programs that exist in the staffing, in the insurance industry, it's not uncommon for them to use a occurrence-based policy to address professional liability. And if you've got a buyer, who's got a claims made policy, or vice versa, where we've got, a buyer with an occurrence policy buying a claims made policy, there are different things that you have to do to structure the ongoing policy correctly so that claims made and occurrence essentially sync up. It's like I said, really closely related to the way you would look at retro, continuity, and pending and prior dates. But that is exactly where you want to make sure you've got a professional in your corner who's going to look under the hood and take a deep dive and not just check it off the list as, yep, it's in place, we're good.
Let's get to the topic that is always negotiated heavily by sellers and buyers, and that is how long, right? I mean, well, and most times you can get over the hump that we need tail insurance, and we certainly need certain coverages extended through the tail insurance. There always becomes the debate, well, how long do we need the insurance for? I don't know, Tony, Kevin, when do you want to jump in on your opinion of how long?
Well, I'll quickly start, and I think Tony can kind of finish it off a little bit. It's pretty interesting, Marty, where how long is really just a determination of risk tolerance of a very entrepreneurial industry in and of itself. It's interesting how the opinion flips, where that'll never happen to me, flips from that'll never happen to my business to that could happen to my business the moment you're about to either buy or sell. How long is really just one, a product of the policy that you're buying. Sometimes it's actually in there. It's like we call it tail coverage, which really just extended reporting period. And you have the availability sometimes on a policy, and it'll actually just be written specifically in the policy to say you could get 1 year up to 3 years, sometimes 5, at a particular price point. And that's generally defined in the policy. So how long is really just depending on where the buyer and the seller are in agreement or disagreement on the true exposure out there. Is it worth buying it, and have it impact the deal and how the deal's structured and what potential considerations could go in. That's kind of my take on it. Tony, you have anything to add?
Yeah, the only other thing I would add is it also depends upon, I think, the maybe severity impact associated with some claims that could come down the line. So, for example, public D&O, you're always going to be looking at a 6-year tail, right? Based off of the frequency of M&A claims or probability, I should say, of an M&A claim at some point popping from public D&O transactions. We see that as commonplace, and maybe something more on the med mal side as well, right? Where again, you've got not small claims that take place over there, so you tend to see a little bit more aggressive tail terms as far as related to how long that tail's in place on those kinds of deals.
I think that's a great point. I do a lot in healthcare staffing, both with folks who are placing physicians, whether it be as locums. I know you do as well, Tony, or even with nurse practices, that those claims can be incredibly large claims, and extending the tail coverage is critical. And I get asked the question all the time, and I think you guys are putting it in one perspective, which is great. There's a risk exposure, business risk tolerance factor to this. Yes, I'll put on the lawyer hat. There's also things called statute of limitations, right? And one thing that I always have to tell the buyers is understand that you put a 2-year policy in place. But on this particular risk that you're worried about, the statute of limitations is 3 years, right? Or it's 6 years, or it is 2 years. So need to make business decisions, big proponent of business decisions. I would say be informed about what the actual risk is and what the actual statute of limitation is, and understand how much risk is exposed, because if the policy doesn't match the statute of limitations, you've got tail exposure that's going to be uncovered.
Absolutely. Yep.
Let's wrap up maybe by talking about a few things really specific to our industry and certain types of risk, and covered most likely in tail policies, not covered. So we've been hitting on employment related, right? It doesn't matter whether you're light industrial, healthcare, IT, your biggest risk is employment compliance. And a subsegment of that is employee benefits, right? You've got 2 risks there. Talk about coverages and whether tail works effectively for those or is not covered for those, and some thoughts that you give clients about that particular area.
Yeah, sure. I can jump in to start, Kev. So employee benefits, like you said, Marty, that, an area where when you're acquiring an entity, you are acquiring essentially the them being compliant or non-compliant in the employee benefits world, right? Same goes with a little nuance in the workers' compensation world. The state of Ohio Bureau of Workers' Compensation, they get a very different feeling as you know it relates to acquiring tail of a seller in Ohio than anywhere else in the country. So those are maybe instances where there's not really an off-the-shelf traditional tail product other than reps and warranties that you could utilize to address that exposure, because really what a reps and warranties policy is in place for is to make sure that the certain representations that a seller is making, i.e., hey, we've taken these steps in our employee benefits program and we are compliant. You know, if that ends up not being true post sale, then the really only way that a buyer could recoup losses that they have financially because of a misrepresentation would be through a reps and warranties type policy. That's probably I think the best example I would have of something in this lane.
Yeah,
And
I
Marty,
think,
yeah, I gave this. Go ahead.
go
I'm
ahead,
sorry, Marty. Go ahead.
Kevin. Go ahead.
Well, I was actually thinking it's along those same lines with the world of cyber and all the exposure that's out there today. A vulnerability or a bad party getting penetration into your system and just sitting there. There are instances where maybe an IT professional within the organization is made aware of it. Maybe they make the CFO aware of it, but the CEO doesn't know. They just were like, let's just not bother them with it. We haven't been hit with it. We don't think they got any data. We're not sure. And it's just one of those things that's just sitting out there unknown. And in a transaction, you're going to represent certain things. The CEO or the owner is going to represent certain things that they think to be true. And then the acquisition occurs, and all of a sudden, 10,000 social security numbers of the company that they just acquired were found to be leaked into the dark web. It's trailed back to the company that they acquired. Did the CEO know? Did the IT professional and the CFO know? Yeah, they did. How does that affect the representations and the warranties that the CEO made? Those are the really tricky ones. Cyber, it can get very, very tricky. And, a reps and warranties policy can help kind of smooth that over a little bit on potential knowledge of a transaction. And what it also does is it allows during the transaction, someone to dig a little deeper in the details of the business that you normally wouldn't think about. So that's kind of like an ancillary benefit of looking at a reps and warranties policy. It makes you look a little deeper to see what you're representing, what you're not.
Yeah, I don't think many, obviously sophisticated buyers do understand this, but I think there are a number of buyers out there who don't understand that rep and warranty insurance is kind of a backdoor way to insure yourself for some things that may not be covered under our traditional policies in our industry. Or if the seller that you're acquiring isn't working with an industry broker and doesn't have the right policies in place to begin with, where there might be coverage, like you said, Tony, they don't have coverage for temporary employees and EPLI, they only have internal. There is a backdoor way through rep and warranty insurance to sometimes get that covered. And I have been seeing it dropping down. I mean, it's expensive product, let's be honest, compared to tail insurance. Rep and warranty insurance is going to be a more expensive product. But the pricing has come down. There are a lot more options in the marketplace today. And it's something that buyers should be thinking about. Well, this was fantastic, and really appreciate your time. I think we really dug into some pretty simple concepts and some very complex concepts. Really, I think our staffing industry clients who we put this out to and who listen to this are really going to benefit. So I appreciate both of you coming on, and enjoy the rest of your day.
Yeah, appreciate you having us, Marty. Thank you so
Thanks,
much.
Marty. Always appreciate it. Thanks everyone for clicking on this video. Appreciate it.